Investors are adjusting their expectations for rate cuts from here, with futures now putting a 0% chance on a half-point cut in November next month. Not long ago, that was the conventional wisdom. And by not long ago, I mean last week. The chance for a quarter-point cut is now at 85%. All of this, of course, following Friday's blowout jobs report, which caught many by surprise. But not our next guest. His firm nailed it. They basically got Friday's number exactly right. But he says we shouldn't expect to see these kinds of gains going forward. Joining me for more is Thomas Simons. He's Jefferies' senior U.S. economist, along with our very own Steve Liesman. Welcome to you both. Tom, not to bring you here to you and I both know how, and Steve, how hard it is to get this right for more than 1 month at a time. But it's important to unpack why you got it right, which is that there were a number of almost technical things kind of all coming together. What were those, and why don't you expect similarly strong readings in the next couple of months?
Sure. Yes. Thank you for having me. And yes, to your point, in economic forecasting, getting something right doesn't give you much confidence that you're going to continue to get it right, unfortunately. That being said, there were a number of technical factors lying underneath the surface that gave me this hunch that we could end up with a strong side surprise. So first up, seasonal adjustments. Seasonality is pretty extreme in September because you have workers coming back to schools that have reopened from summer break. Oftentimes that ends up being a plus or minus a million over the course of the summer. And so the adjustment factor is big. In this case, it actually, is trying to push down the number to normalize it. And what we've seen in the post-COVID period, in my view, is that the seasonals have been taking out less in the months where they take jobs out. So there was that. There's also the birth-death model, which has been running pretty hot recently and generating a lot of jobs. That is, based on an assumption that small business creation rates are still more or less where they were in 2021, 2022. I don't think that that's very likely. The reopening story is mostly played out. We've kind of matured past that. And then there's just, a number of other quirks that are difficult to understand.
Sure.
I'll just point out one really quick. Residential construction has been positive for 3 years now, something like that. And this is as we're seeing the rates of home construction fall off significantly, and the rates of completions of those projects exceed the rate of new projects. So that's unusual. Usually that starts to be, kind of a impetus for lower construction payrolls. That's going to come at some point, but so far, whatever is boosting them up is still intact, it seems.
So if the number is a little bit of too good to be true, my words, not yours, you'd think the market would wake up this morning and start discounting that a little bit. But if anything, it's going the other way. It's saying more or less, we take this at face value. The economy is stronger than expected. Over the weekend, I'm sure Steve saw this too, the number of strategists who are now raising their year-end price targets, talking about earnings and multiple expansion into next year. I mean, this jobs report seems to have been a catalyst for massive sort of upward revision and broad bullish sentiment on markets and the economy. Is that a mistake?
I wouldn't call it a mistake necessarily. You can only do so much with the information that's in front of you, right? You can only make the best judgment based on your past experiences and whatnot. In this case, I think a lot of people, when they try to discredit the strength of a labor market report, they look for inconsistent details. And if you were doing that this time around, you would still be looking for them because there really was nothing in the data at all that was in any way weak. And even to that point, we had upward revisions to the last couple of months.
True. This
is following a year-long period of time where we've had nothing but downward revisions. So everyone forgot about the benchmark revisions, the 818,000 fewer jobs created in the last year, and is still now just focused on maybe some of the slower period of growth that we saw at the end of 2022 and the beginning of 23, maybe that was the recession in a sense, right?
No, I've been thinking that I'm so glad you put it that way. And to make it clear, your forecast now is only for quarter point cuts from here on out, much like the market. Steve, exactly what Tom just said is, did the slowdown already happen?
Yeah. First of all, hats off to Thomas. Economists do a victory strut around the office when they're plus or minus 50,000, let alone getting the number darn close to right and being on the upside surprised of that. So that's real good work right there. I think what's happened, Kelly, is an adjustment from the reasons why the market thought the Fed was cutting. I think your question is a good one, but why is the market taking this at face value? We have to think about where the market psychology was going into that jobs number. There was real concern that the jobs market was weakening fast, and we'd had a couple bad reports. And so what this did is draw people back to really be where the Fed is. This idea of Powell stepping forward and saying, hey, we're not cutting because of weakness. And before the jobs number said, yeah, you say that, but we don't believe you. Well, now they kind of believe him. And if you think about where we are right now, we're now, as you said, dialed out the 50 for November, now on a quarter. And by the way, there's about a 15% probability of no cut. And then you layer that into December, and there's still a probability of, if they cut in a quarter, then 11% probability they don't do it again. And then a more likely probability that they'll cut another quarter. So another 50. Guess what, Kelly? That's exactly where the Fed is for this year in their median forecast of all the Fed officials. So what we've gone from is one of, hey, the Fed is going to cut because the economy is weakening fast, to, hey, the Fed's going to cut because rates are too high relative to inflation and the economy's okay.
And Steve, where does this leave us now for the next couple of weeks, with the next big event being the election? And other than CPI being negative, I just can't imagine what would move the market much in terms of its expectations for November.
Well, the CPI is going to be something that has to be followed. As you know, we put together the CPI and the PPI. We come up with PCE for the end of the month. That's the important metric. I'm seeing forecasts for PCE be relatively tame, or the inflation index be relatively tame for this quarter. I'm looking at the retail sales number, which comes next week. And that's going to be a big metric to see how the consumer is faring. And then we have another jobs report before the election. And then what I'm hearing, and I'm going to do a report on this tomorrow, Kelly, with our rapid update of where GDP forecasts are for the next 4 or 5 quarters. And I'm hearing people saying, you know what? The election is not necessarily a factor because we expect divided government.
Bingo. And that's exactly what we heard David Tepper say a couple weeks ago as well. Right.